Welcome back to the deep dive. We're here to take that really dense AI-driven financial data and make it make sense for you.
Yeah, absolutely.
Today, we're getting pretty technical. Think of it like putting on our institutional trader hats.
Definitely.
We're doing a deep forensic look at the big Bitcoin ETFs using this pretty comprehensive AI report from the week ending October 24th, 2025. Market close data.
Right. And this isn't just skimming the surface. We're really trying to get into the mechanics of how this market is working right now.
Okay.
We're using purely quantitative stuff here, all the indicators the AI flagged. So volume ratios, daily true value, buyer-seller power, which is crucial squeeze dynamics, moving averages, the works across all the main spot ETFs.
Okay, let's unpack this then. We're not here to debate Bitcoin itself, good or bad.
No, not at all.
We're asking, what's the AI telling us about conviction? About where the money is actually flowing, or maybe not flowing, and what's the underlying tension in the market this past week?
And honestly, what we found looking across pretty much every single ETF symbol in the report, it's a story of inertia. It's kind of stuck.
Inertia, like just stalled.
Yeah, exactly. You've got a market that seems really leveraged, positioned maybe, but there's just no follow-through. Not from the bulls, not from the bears. It's stuck in the middle.
All right, so let's start big picture then. Aggregate market view. Volume trends first. That usually tells us if people are actually, playing the game or sitting out.
Good place to start. And the daily volume picture, like today's volume versus yesterday's speed, it was really volatile within the week.
Okay.
You had some funds that kept up engagement pretty well.
Yeah.
96%, 89%, 86%, 83% of the previous day's action. That's pretty active.
Mm-hmm. Still busy?
But then you saw this steep drop-off elsewhere. Funds down around 74%, 66%, 65%, and one was really quiet, down to like 42% of the prior day's volume.
Wow, 42%. That's a big dip day over day for one fund.
It is. It just shows that, yeah, some of these ETFs are super liquid, constant churn, but others, they can add these days where liquidity just dries up.
Right.
And if you're trading at 42% of yesterday's volume, well, a big order coming in could really move the needle disproportionately that day. Makes it riskier.
Okay, but the bigger story you said was about the market cooling off. That came from the weekly volume ratio, right? Comparing last week to the week before.
Exactly. That's where you see the pullback really clearly.
So what did that show? Were investors stepping back?
Overwhelmingly, yes. The main theme was a significant retraction across the board. Most funds traded way less volume than the week before. We saw numbers like 75%, 70%, 55%.
So down 25, 30, 45% week over week.
Yeah, and some even more dramatic, down to 34%, 35% of the prior week's volume.
Whoa.
It really suggests that the previous week might have been, I don't know, really exciting, or maybe a big liquidation event happened. And this past week was everyone just pausing, catching their breath, no momentum to keep pushing whatever move happened before.
So yeah, if your weekly turnover drops by 65% down to 35%, that's not just cooling. That feels like people actively deciding, nope, I'm sitting this one out.
It really does. But, and this is important, there were a couple of outliers. Can't ignore those.
Okay. Who bucked the trend?
Two specific funds actually kept up pretty strong weekly engagement. Their ratios were 89% and 95%.
So almost the same volume as the week before while everyone else was retreating?
Pretty much. And when, maybe 80% of the market pulls back and two funds just hold steady, that tells you something.
Like what? Maybe dedicated money?
Could be. Maybe it's steady institutional flow in those specific ETF that doesn't care about the wider market swings. Or maybe it was concentrated activity, like rebalancing or someone specifically accumulating in just those two. Interesting divergence.
Okay, so that sets up a conflict right away. Mass retreat, but focused stability in a couple of spots. Now let's get to what you called maybe the most critical finding, the moving averages, the MAs.
Yeah, this is where the AI synthesis really shines, I think, because it's so consistent.
What did it show?
Across almost every single symbol, from the giant I bit down to the tiniest ones, the positioning was identical.
Identical. What was it?
Above 200 days moving average, but at the same time, below 200 hours moving average.
Below the 200 hour.
Above the 200-day, below the 200-hour.
Okay.
Okay, unpack that for us. What does that specific conflict actually mean for someone watching this market?
Right. Think of the 200-day moving average as, like, the market's climate. It's the long-term health of fundamental trajectory.
Okay, the big picture trend.
Exactly. Being above it. That confirms the underlying structural bull case for these Bitcoin ETFs is still technically intact. The foundation's holding. The multi-month trend is up. That's good for long-term holders.
Okay, makes sense. So what about being below the 200-hour MA?
That's more like the weather. It's the immediate day-to-day, even hour-to-hour momentum.
Right.
Being below that 200-hour level means short-term selling pressure or maybe resistance from prices just overhead or just the intraday action. It's winning out right now. It's pushing back against that long-term strength.
So the immediate price action is weak, even though the long-term trend is strong? Precisely. It's like, imagine a really solid skyscraper. That's your 200-day MA support. But right now, there's this strong wind hitting the upper floors. That's the 200-hour resistance, and it's stopping the elevator from going any higher.
Huh.
And that dynamic, that compression between long-term support and short-term resistance, it basically forces things. It tells you that this sideways chop, this low volatility, probably isn't going to last. Something's got to give.
So it sounds like a tricky spot, especially for short-term folks. They see the hourly chart looking weak, might want to sell.
But the 200-day is sitting right below, saying, hey, maybe not so fast.
Right, because selling here might be selling right into major long-term support.
Exactly. It forces a decision.
Yeah.
Are the short-term sellers strong enough to actually push the price down through that 200-day support?
No.
Or is that 200-day going to act like a magnet, soak up the selling, and become the launch pad for a bounce that finally breaks the 200-hour resistance?
That's the million-dollar question, I guess.
That's the primary tension this data set highlights for the next period. Absolutely.
Okay, let's shift gears slightly. Talk about price valuation. The report mentioned daily true value and also flagged unusual activity pretty much everywhere. What's that about?
Well, when the AI flags unusual activity across the board like that, it's usually picking up on something systemic. It's comparing current price action to its own internal models, models built on recent processes, volatility, volume, maybe even the underlying Bitcoin price itself.
So unusual means the price isn't behaving the way the AI expected based on recent history.
Yeah, or maybe the volume pattern associated with the price moves is weird. It's basically saying the whole period felt statistically off.
Yeah.
Anomalous.
Okay. And within those anomalies, the actual daily true value calculations, they showed most funds were maybe a little bit cheap, like 1% undervalued.
That was the general theme, yeah.
Yeah.
Consistent with the weak short-term momentum, maybe things looked slightly like a bargain on a daily basis for most of these ETFs.
But there were outliers, again, weren't there? And this is where you said it got really interesting.
Absolutely. Because while most were slightly undervalued, suggesting maybe a buying opportunity, a few were flagged as significantly overvalue.
How significant?
Well, there was one at 1% overvalue. Okay, maybe not huge. But then another flagged at 7% overvalue. And one real standout. The AI calculated as 12% overvalue based on its daily model.
12%. In an ETF market that's supposed to be pretty efficient? That sounds huge.
It is huge. A 1% difference is maybe noise, but 7%, 12%. That's screaming that something specific is happening with that particular fund, likely tied to how easily you can actually create it. It points to potential inefficiency.
Okay, hold that thought on the outliers. Let's drill down into the specific ETFs now. Starting with the big players, we have to talk about the sheer scale difference.
Well, especially with IBIT.
Yeah, IBIT, the iShares Bitcoin ETFs. It's the 800-pound gorilla in this market right now. Its volume dominance shapes everything else.
So price was around $62.83 at the close, but the volume number, almost 30 million shares traded daily, 39,980,939 to be exact. Yeah, let that sink in. Nearly 40 million. We have to emphasize that because the next closest competitors are trading, what, a fraction of that.
A tiny fraction. It shows you where the serious institutional money, the big block trades are happening. It's almost all in IBIT.
Right. And beyond just volume, its technicals are telling. It had the highest implied volatility rank, the 5E rank, at 58%. But critically, it was D-N-ward, downward.
Okay, quick refresher. 5E rank, 58%. N-word. What does that mean in plain English? High volatility expected, but maybe less so than before?
Sort of. 58% means IV is currently higher than it's been 58% of the time over the look-back period. So yes, options are pricing in more risk than average.
Okay.
But the D-N-word part is key. It means that elevated IV is actually starting to decrease. Option sellers might be getting more active, collecting premium, pushing volatility down. It suggests the market is anticipating less sharp movement soon, which fits perfectly with that consolidation, that inertia story.
Got it. And IBIT's other readings. Buyer-seller power. Trend.
Same story there. Seller DN, buyer DN, both sides losing power. And the trend. End trend. No trend.
So even the giant, the one with 40 million shares changing hands, is basically directionless, treading water with both buyers and sellers losing steam.
That's the takeaway. Huge volume, yes, but conviction, not this week.
All right, now let's look at that next tier down. ARKB, GBTC, FBTC, volumes all bunched together, right? Around 2 to 3 million shares each.
Yeah, ARKB at about 3.1 million, GBTC at 2.9 million, FBTC at 2.6 million. Still significant activity, obviously, but
Like 115th of IBIT's volume, it's a massive drop-off.
it really highlights IBIT's role as the main trading vehicle. But these others are still important. Let's look at ARKB, the ARK21 Shares Fund. Priced lower, $36.74. IV rank 43% N-word. But the interesting thing was its trend
What was different?
is the only one in this top group listed as M trend, medium trend. Everyone else was N trend, no trend.
Huh. Why would ARKB show a medium trend when the others, including the huge IBIT, showed nothing?
Good question. It suggests maybe there was some kind of persistent directional flow, specifically in ARKB during the week. Not enough to be a strong trend, but maybe some smaller institutional money or dedicated retail buying, perhaps, targeting just that fund, enough to register as medium while the others were just balancing out.
Interesting. Okay, then the other two in that tier, GBTC and FBTC, these were the higher priced ones, right?
Yeah. GBTC, the grayscale fund, closed around $86.69. IV rank 47% N-word, also N-trend.
And FBTC, the Fidelity one.
Highest price in this group, $96.48. IV rank 49% N-word, and again, N-trend, no trend.
Okay, so this raises that question again. Why is FBTC almost $100 a share and IBIT is like $63, even though IBIT trades 15 times the volume? That seems weird.
It does seem weird, but it's purely down to the fund's structure specifically. How many shares were created relative to the Bitcoin held when they launched?
Ah, okay. Share structure.
Exactly. IBIT and FBTC just decided on different share counts per Bitcoin. Think of it like slicing the same pizza into more or fewer slices. The pizza is the same size, but the price per slice changes. IBIT have more slices outstanding, so each one costs less. FBTC has fewer, so each costs more.
And GBTC's high price. Is that the same reason?
Similar, but also tied to its history. Remember, GBTC was a closed-end trust for years before converting to an ETF.
Right. It used to trade at those crazy premiums or discounts.
Exactly. It couldn't easily create or destroy shares back then, so its share price got disconnected from the actual Bitcoin value. Even though it's an ETF now, that legacy structure and share count contribute to its higher price per share. Plus, maybe IBIT's lower price just feels more accessible to retail, helping drive its volume.
Could be. But the main point here is that for IBIT, GBTC, and FBTC, the big dogs, besides ARKB, the AI, flagged N trend, no trend, which just hammers home that consolidation point you made earlier with the moving averages. Lots of churning, lots of trading, but ultimately going nowhere fast.
It's a market holding its breath,
Yeah.
waiting.
Okay, let's push beyond just price and volume then. Let's get into those more advanced metrics the AI uses. Power squeeze, directional force. This should tell us why it's stuck, right? The internal mechanics.
Exactly. And the buyer-seller power metrics are incredibly revealing here.
What did they show? You said it was uniform.
Amazingly uniform
Right.
across every single symbol listed in the report. EDIT, ARKB, GBTC, FBTC, all the smaller ones, even the Bitcoin futures contract they included.
Wow, okay. All of them.
All of them. The reading for both the daily buyer-seller power and the weekly buyer-seller power was identical. Seller Dean, buyer Dean.
Seller down, buyer down. Explain that. It sounds like total exhaustion from both sides.
That's a perfect way to put it. Think of it like a tug-of-war.
Okay.
Seller D means the sellers, the ones pushing the price down, are losing their strength. They're not hitting the bids aggressively anymore. But buyer D means the buyers, the ones who should be stepping up, especially with those slight undervalue readings. They're also losing strength. They're not chasing offers higher.
So both sides just drop the rope.
Basically, yeah. It signals profound market inertia. Aggressive selling is drying up, but aggressive buying isn't stepping in to fill the void. Market makers are probably just sitting back, quoting wide spreads maybe, and directional traders are clearly hesitant. Nobody wants to be the first mover.
And when you get that draining of power from both sides, that sets up the squeeze, right? That's what that metric is about.
Precisely. The squeeze metric, typically calculated by looking at how tight volatility bands like Bollinger Bands get relative to average range indicators like Keltner channels, it measures compression.
Okay.
When volatility collapses, like it seems to be doing here according to the low IV ranks, and directional power vanishes, as confirmed by seller D and buyer DN, the AI flags a squeeze. It means energy is building up, coiling like a spring.
So a market in a squeeze with no one pushing hard either way. It's basically saying a big move is coming. We just don't know which way yet.
Mathematically, yes. An explosive directional move becomes much more likely once something breaks the stalemate. A news catalyst, a technical level break, something to release that coiled energy.
It's the calm before the potential storm.
Okay.
And reinforcing this idea of a tight, non-trending market, the open gap status.
Right. That looks at whether the market opened significantly higher or lower than where it closed the previous session. Gaps usually show strong conviction carrying over.
And what did it show here?
For all symbols, it was noted as in range. No significant gaps up or down. Prices just picked up pretty much where they left off. It reinforces that consolidation picture. No overnight shocks, no weekend surprises forcing a big jump.
Yeah.
Just tight, continuous trading within the range.
Okay, and let's quickly revisit the implied volatility, the IV rank. We said IBIT was highest at 58% N-word, but generally it was pretty low across the board, right?
Yeah.
Down to like 37% for one fund.
Yeah, generally quite depressed. And low IV means options are cheap. It's cheaper to buy insurance, basically.
So the options market wasn't expecting fireworks either?
Not in the immediate term, no. It confirms the consensus view. The market's stuck, probably going sideways for a bit longer. But, and this is crucial, historically, periods of extremely low compressed IV are often the fuse that gets lit right before a really high momentum breakout.
Ah, so low IV means low expectations, but it can also mean complacency before a big move.
Exactly. It's a warning sign. The current quiet might be fragile.
Okay, this is fascinating stuff. And look, if you are enjoying these insights, digging into this AI data with us, make sure you hit that follow button.
Yeah, and turn on notifications too. That way you'll get our market analysis update each week, right when it drops.
We really focus on unpacking these complex technicals, trying to give you that clarity, especially when the market's in a tricky spot like this.
Absolutely. Okay, so where were we? Ah, the smaller players.
Right, the rest of the field. We covered the top 4 or 5. Let's quickly run through the medium and smaller volume ETFs. They might not drive the whole market, but their data can show different risks, right?
Definitely. Especially liquidity risks and those pricing quirks we talked about.
Okay, so below the top tier, we had BITB, the Bitwise ETF, volume around 1.5 million shares, price about $60, IV rank 44%, still pretty decent volume.
Yeah, it's still functional. Then HODL, the VanEck fund, that was just under 1 million shares in volume, around 995K. Low price, $31. And that one had the lowest confirmed IV rank down at 37% N-word. Very low expectation of movement there.
Okay, and then the volumes really start to drop off, right? Into the micro volume category.
Yeah, this is where things get thin.
Yeah.
You had BRR, the CoinShares ETF, around 286,000 shares. Still something.
But then
Then it falls off a cliff. BTCO, the Invesco Galaxy Fund, only traded about 86,000 shares.
Yeah.
EasyBC, Franklin Templeton's around 85,000, and BTCW, the Wisdom Tree one, just 22,591 shares daily.
22,000 shares. Compared to IBIT's 40 million, that's tiny.
It's minuscule, less than 0.06% of IBIT's volume. And when trading activity is that thin, the price becomes super sensitive to even small orders, which brings us back to those outliers.
Right. The daily true value outliers. We saw 1%, 7%, and that crazy 12% overvalue reading. Is it safe to assume those huge deviations were probably happening in these really illiquid funds like BTCO and BTCW?
That's almost certainly the connection the AI is making. When a fund like BTCW trading only 22,000 shares gets flagged as 12% overvalued.
It's not because the Bitcoin inside suddenly jumped 12%.
No way. It's because it takes almost nothing to push the price around. If even one decent-sized buyer comes in and says, I want BTCW shares now, and there are hardly any sellers, they can easily push the price way above fair value just to get their order filled.
So it's like that coffee analogy. If the AI says coffee is $5, but there are only 22 cups available and someone really wants one, they might pay $5.60 just to get it. That 12% premium is just scarcity.
Exactly. It's pricing inefficiency driven purely by lack of liquidity. And look at their prices too. BTCO at $110, BTCW at $170. High price per share plus ultra low volume. It's the perfect recipe for these kinds of technical disconnects.
So these illiquid outliers, they represent pockets of risk or weirdness even if the main market seems stable.
Precisely. They're worth watching. Also notice that for some of these really small ones, the IV rank was just listed as NA% N-word.
Meaning, not enough data or options trading.
Probably.
Yeah.
Just indicates potentially less liquid options markets or maybe newer data sets for those specific tickers.
Okay. And finally, just to show how broad this AI analysis was, the report even included a futures contract, right? MBTV 25.
Yeah, the micro Bitcoin futures.
Yeah.
Volume there was about 55,000 contracts, IV rank 40%, including it shows the AI is looking at the whole ecosystem spot, ETFs and derivatives.
And did the futures show the same patterns?
Critically, yes.
Yeah.
It also reported seller DN, buyer DN for its power dynamic.
Ah, okay.
Yeah.
So that confirms the exhaustion, the inertia. It wasn't just an ETF thing. It was market-wide across Bitcoin trading vehicles.
That's a key confirmation. The whole system was showing the same lack of conviction.
Got it. And one last number mentioned in the source, $111,005. Any idea what that represents? Seems specific.
Hard to say for sure without the full report context, but given its size, it's likely some kind of aggregate measure, maybe total dollar value of the true value deviations across all funds, or some composite score.
Yeah.
It just reinforces how quantitative and calculation-heavy this AI analysis really is.
Okay. So let's try to wrap this up. Synthesize the whole week ending October 24th. What's the big picture takeaway from all this AI data?
I think the big picture is this state of high tension. The market is really caught between conflicting forces.
Okay, conflict number one.
Volume versus conviction. You got massive volume, dominated by IBID, showing liquidity is there. But conviction is rock bottom. That universal seller D and buyer D and all the end trend signals prove it. Lots of churning, no direction.
Makes sense. Conflict number two.
Structure versus momentum. The long-term structure looks solid. Everybody's above the 200-day MA. That underlying bull trend is intact. But the short-term momentum is fighting gravity. Everybody's below the 200-hour MA. Immediate price action is weak, hitting resistance.
So we've got this picture of a market coiling up in a squeeze. Directional power is gone. Volatility expectations are low. No gaps. It's just waiting.
Exactly. Waiting for a catalyst.
Yeah.
Something to either break that 200-hour resistance decisively or force a real test of that big 200-day support level below.
So for someone listening, maybe an investor or a trader, what does that mean practically?
It means this current price range is probably temporary. It's compressed energy. This isn't likely the time for aggressive new directional bets. It's a time for watching closely, for vigilance, waiting for the break.
Okay, so here's the final thought then, the provocative question maybe. If the AI says the market's power is totally drained, it's stuck in this squeeze, where does the catalyst come from? What breaks the deadlock?
That's the key question.
Will it be the leader, IBD? Does its massive liquidity mean it has to be the one to eventually gather steam and force a breakout up or down?
That's one possibility. The volume leader dictates terms.
Or could the break actually come from the other end? Could one of those weird, illiquid, high-priced outliers like BTCO or BTCW experience some kind of localized shock due to their thinness, maybe triggering a cascade effect?
That's the other risk. Does an issue in the periphery ripple inwards? The tension between the liquid core and the illiquid fringe is fascinating right now.
So institutional volume breaking the range versus low liquidity risk forcing the issue, which one wins out?
The direction of the eventual break will tell us a lot about whether accumulation or liquidity fears are the dominant force right now.
Absolutely fascinating. And look, if you found this deep dive valuable, if you appreciate getting into these details,
Please do hit that follow button and turn on notifications. We do this every week.
we'll be right back here next week to unpack whatever happens next in this technical setup.
Keep watching the data.
We'll see you on the next deep dive.